single day. I'm gonna make something great. That's my way.
Hello everyone, and welcome back to my channel. I am Ginger Wolf, and this is Stripped Finance. I am a future entertainer and stripper, not a financial consultant. So any and all information received from this channel is meant only for educational, informational, and entertainment purposes. So please, if you have any questions or concerns, take it up with your financial consultant. Now with that out of the way, let's enjoy today's video. Bye!
Hello everyone, and welcome back to Stripped Finance. Today we are going to be going over more stock market stuff. So today I thought we would handle a bear market because I like bears. They're cool. Anywhoosie, so today is an Investopedia day. As I've said in multiple videos before, I just really like their setup, and it makes, videos easy to make, easy to follow. So let's get started. Today's article is Bear Markets, and it is by James Chen, reviewed by, I'm probably going to butcher this name, I am so sorry, but it is reviewed by Kadia Karit and fact-checked by Marcus Reeves. If I mispronounce the names, I'm super sorry. So, what is a bear market? A bear market is when a market experiences prolonged price declines. It typically describes a condition in which security prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Bear markets are often associated with declines in an overall market or index like the S&P 500. But individual securities or commodities can also be considered to be in a bear market if they experience a decline of 20% or more over a sustained period of time, typically 2 months or more. Bear markets also may accompany general economic downturns such as a recession. Bear markets may be contrasted with upward trending bull markets, which we will do a video on probably tomorrow. True. The key takeaways. So basically just to summarize. Bear markets occur when prices in a market decline by more than 20%, often accompanied by negative investor sentiment and declining economic prospects. Bear markets can be a cycle or longer term. The former lasts for several weeks or a couple of months, and the later can last for several years or even decades. Short selling, put options, and inverse ETFs are some of the ways in which investors can make money during a bear market as prices fall. So, understanding bear markets. Stock prices generally reflect future expectation of cash flow and profits from companies. As growth prospects wane and expectations are dashed, prices of stocks can also decline. Herd behavior, fear, and a rush to protect downside losses can lead to prolonged periods of depressed asset prices. One definition of a bear market says markets are in bear territory when stocks on average fall at least 20% off their high. But 20% is an arbitrary number, just as 10% decline is an arbitrary benchmark for correction. Another definition of a bear market is when investors are more risk-averse than risk-seeking. This kind of bear market can last for months or even years as investors shun speculation in favor of boring sure bets. The causes of a bear market often vary, but in general, a weak or slowing or sluggish economy, bursting market bubbles, pandemics, wars, geopolitical crises, and drastic paradigm shifts in the economy, such as shifting to online economy, are all factors that might cause a bear market. The signs of a weak or slowing economy are typically low unemployment, low disposable income, weak productivity, and a drop in business profits. In addition, any intervention by the government in the economy can also trigger a bear market. For example, changes in tax rate or in the federal funds rate can lead to a bear market. Similarly, a drop in investor confidence may also signal the onset of a bear market. When investors believe something is about to happen, they will take action, in this case selling off shares to avoid losses. Bear markets can last for multiple years or just several weeks. A secular bear market can last anywhere from 10 to 20 years and is characterized by below average returns on a sustained basis. There may be rallies within secular bear markets where stocks or indexes rally for a period, but the gains are not sustained and prices revert to the lower levels. A cycle bear market, on the other hand, can last anywhere from a few weeks to several months. The U.S. major market indexes were close to bear market territory on December 24th of 2018, falling just shy of a 20% drawdown. More recently, major indexes, including the S&P 500 and the Dow Jones Industrial Average, fell sharply into bear market territory between March 11th and March 12th. Hold on. My computer decided that I did not have enough space. I told it I do have enough space. But this is as good a place as any to throw in our sponsor for today. Even though they're not actually sponsoring me, I'm kind of sponsoring them. But kind of like where you're from. So, Scores in Mooresville, North Carolina. If you've never been, you should go. We got a beautiful club, great food, and beautiful women. I mean, there's not much you can do to bump that. It's pretty great. I love it there. Been there for like 7 years. Anyways, prior to that, the last prolonged bear market in the United States occurred between 2007 and 2009. During the financial crisis and lasted for roughly 17 months, the S&P 500 lost 50% of its value during that time. In February of 2020, global stocks entered a sudden bear market in the wake of the global coronavirus pandemic, sending the Dow Jones down 38% from its all-time high on February 12th to a low on March 23rd in just over 1 month. However, both the S&P 500 and the NASDAQ 100 made new highs by August of 2020. The phases of a bear market. Bear markets usually have 4 different phases. The first phase is characterized by high prices and high investor sentiment. Towards the end of this phase, investors begin to drop out of the markets and take in profits. In the second phase, stock prices begin to fall sharply, trading activity and corporate profits begin to drop, and economic indicators that may have once been positive start to become below average. Some investors begin to panic as the sentiment starts to fall. This is referred as capitulation. The third phase shows speculators start to enter the market, consequently rising some prices and trading volumes. In the fourth and last phase, stock prices continue to drop but slowly as low prices and good news starts to attract investors again. Bear markets start to lead to bull markets. One second, guys. Alright, short selling in bear markets. Investors can make gains in a bear market by short selling. This technique involves selling borrowed shares and buying them back at a lower price. It is an extremely risky trade and can cause heavy losses if it does not work out. A short seller must borrow the shares from a broker, before a short sell order is placed. The short seller's profits and loss amount is the difference between the price where the shares were sold and the price where they were bought back, referred to as covered. For example, an investor shorts 100 shares of a stock at $94. The price falls and the shares are covered at $84. The investor pockets a profit of $10 times 100, $1,000. If the stock trades higher unexpectedly, the investor is forced to buy back the shares at a premium, causing heavy losses. So that's looking like it's going to be all for today, guys. I'm probably going to do a video probably tomorrow about bull markets, because you can't have just one side of the coin. So I will see everybody tomorrow. Bye! Hi everybody, thanks for making it this far. Don't forget to like, comment, subscribe, share the channel, all that good stuff. So, this is your financial bartender serving you up shots of inspiration. I'll see you later. Bye!